Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Conference. And I'm here with Michael Arone, who's the Managing Director of U.S. Intermediary Business Group at State Street Global Advisors. Great to see you, Mike.
Good to see you, Tom. Thanks for having me.
So there's a lot going on with the markets, markets around the world, here in the U.S. We got the Fed to be concerned about. You guys meet with thousands of advisors every year. As we're closing out the end of the year, what are you telling advisors that they need to be thinking about?
Right. Well, thankfully, we have the third quarter is now over with, and we're looking towards the fourth quarter. And one of the big things that we'll be looking for is earnings expectations for companies here in the U.S. And one of the things that we continue to see is that earnings expectations continue to grind a little bit lower. But my expectation is that take out the energy companies, take out the big multinational companies that are impacted by the dollar and exports, and earnings growth is really healthy. Parts of the market like consumer discretionary, healthcare, technology, financials. So we're telling folks, think about the parts of the market that are growing their sales and revenues at the fastest rates. And those are the parts that we like.
And you can't emphasize that enough, because I saw some recent statistics on the last quarter, and they said it almost would have been record-breaking if we didn't have that energy component.
To that point, Tom, if you actually, in the second quarter, if you take out the energy names, corporate profit growth grew close to 10%. So very healthy quarter. It's my expectation we'll see something like that again. Now, what's really interesting is that about 37% of publicly traded companies have begun to increase their revenues. Might sound like a high number, but it's actually lower than back to where we were in 2009. So what you find is when earnings growth is really hard to come by, sales growth is really difficult to generate, those are the people who pay more for those companies. So what we're finding is retail banks, home builders, biotechnology stocks. We think those are good opportunities, particularly after what's happened in the markets recently.
Right. So for advisors, not just in the U.S., but as you look globally, where we've seen some major corrections, what do advisors need to do? I mean, it's almost, they don't want to talk about that with clients.
What's interesting is we have seen financial advisors allocate more assets to Europe and to Japan. They recognize that profits are rising more quickly there. Valuations are pretty strong. They recognize that quantitative easing, a lower currency are tailwinds. What I find interesting is a lot of financial advisors have used currency hedged ETFs to express that view. One of the hottest products of the year. What we've been counseling folks is to think about ways in which to complement those positions. So if you think about it, you typically only hedge between 50%, 75% of your international exposure. And so with the remaining part, we're saying lean into trades that benefit from quantitative easing. Dividend payers, small cap stocks, REITs, for example. So we've been talking to financial advisors a lot about international small cap stocks and international REITs.
Great idea. And let's touch briefly on the fixed income side. Inevitably, the Fed's going to pull the trigger. May not even be this year, but what do advisors need to do in order to make sure they avoid that headwind that's coming?
What's really interesting, Tom, is I've been meeting with financial advisors throughout the country for years now. Folks like me show up and tell them interest rates are going to rise. A few years ago, they did things like invest in bank loans, floating rate. They shortened duration in anticipation of higher rates. They kind of ran out of patience. Now they're hearing that again. So what we're finding is financial advisors looking at different things saying, we're not sure what to do with fixed income. So they're allocating a lot of those decisions to active managers. And as you know, earlier this year, we launched in partnership with DoubleLine, TOTL, our kind of core fixed income allocation. So we see a lot of folks looking towards active core managers to be the ballast in their asset allocation. We're reminding them, when you think about fixed income, you're not looking to extend risk. You want capital preservation, income, and a return that's kind of consistent even when times are tough, like we've had in the last quarter or so. And we see folks using Total as a kind of component of that.
Yeah, absolutely. It's a great product, and I know you've had a lot of flow in that area. And the preservation's been there, good performance so far, so I know you're happy. Mike, as always, it's great to see you. Thanks for your help and guidance.
Good to see you, Tom. Thank you.